Our minimum expectation for us to put any stock into our portfolio, our minimum expectation is that it will deliver a 15% minimum compound annual rate of return over the next 5 years. Moving into Europe reminds me very much of moving into the US with active equity ETFs, fully transparent. In 2014, 2015, most people did not think they would survive. Many teams have a 1-year time horizon or an 18-month time horizon. We have a 5-year investment time horizon. The difference between linear growth and super-exponential growth in the very early years, very little. But if you give us 5 years, that difference is huge. And most analysts and portfolio managers, investors, are not thinking enough, we do not believe, about the super exponential growth trajectories out there.
Star-Investorin Cathie Wood kommt nach Europa. Sie übernimmt mit ihrem Unternehmen ARK Invest den europäischen ETF-Anbieter Rize. Diese Meldung hat für ziemlich viel Furore gesorgt, denn Cathie Wood ist nicht nur eine der bekanntesten Investoren überhaupt, sondern sie hat einen Fokus auf aktiv gemanagte ETFs. Und die sind in Europa noch nicht ganz so bekannt. Cathie Wood hat auch viele Fans, die jetzt hoffen, dass sie ihre Fonds nach Europa bringt. Allen voran zum Beispiel ihr Flaggschiff, den ARK Innovation Fund. Über ihre Pläne für Europa, ihre Investmentstrategie und welche europäischen Unternehmen sie interessant findet, darüber habe ich mit ihr gesprochen. Ein kleiner Hinweis an dieser Stelle, das Interview haben wir auf Englisch geführt. Deshalb, let's switch to English. Hi Cathie, it's a great pleasure to have you with us. Welcome to our video and podcast channel.
Thank you, Suzanne. I'm really, really happy to be here and give you more information about ARK now that we are moving into Europe.
So we've heard that the US ARK fund that you plan to launch in Europe will be as identical as possible to the US originals, so to say. Will you mirror all of the US funds, and where will the European funds differ? Can you tell that?
Sure. Well, we're going to start off with 3 of them, and I'm not sure how much I can talk about them because we're working with the regulators right now. But for 3 of them, and of course our flagship strategy would be one. And the way we're describing how similar they'll be, they will be substantially similar. The only difference will be if there are regulations in Europe limiting a holding to a certain percentage, whereas in the US we might have the same regulation, but we don't have to sell when it hits a certain percentage. Just little technicalities like that, but substantially similar is the right way to think about these funds.
Maybe you can give us an outlook how long it will take until we will be able to invest?
We believe that in the first quarter, our funds will be out. We'd like to think January, but we never can be certain. So pretty quickly, because we actually started work before the acquisition was complete.
How much outperformance do you expect?
Our minimum expectation for us to put any stock into our portfolio, our minimum expectation is that it will deliver a 15% minimum compound annual rate of return over the next 5 years. So 15% roughly on average per year. Given the underperformance in the last 5 years, we would expect it to be much higher than that, especially if we're right, if our research on these new technologies is right. Just to give you a sense of that, in the equity markets today, both public and private equity markets, we believe that innovation, including disruptive innovation, is valued in the marketplace in the $10 to $15 trillion range. Now, not all of those are truly disruptive innovation, but somewhere in the 10 to 15 trillion range. We expect that number to scale to more than 200 trillion over the next 5 to 7 years. That's roughly a 40% compound annual rate of return if we're right on these technologies. And we do believe that it's very important to gain exposure to these technologies because the traditional benchmarks, or the stocks in the traditional benchmarks, we think many of them are going to be disrupted. They're going to face some kind of pressure because they're not adapting quickly enough to these new innovation platforms. And so we think it's very important to get on the right side of change. And we think our portfolios are a big part of doing that. If you look in the world out there, you'll see a lot of index portfolios that are, I would say, scattershot approaches at these new forms of innovation. There'll be, cybersecurity portfolios, and they've got all kinds of interesting names that attract people. But you have to look inside, and so they'll just buy anything that has cybersecurity in the prospectus or in the name. We will not do that. If you look inside our portfolios, you will find rifle shot approaches. We are going to be very focused on the disruptors and the winners in the space. And that's why we have active research and active portfolios. I do believe that over time, this is going to become more apparent and more investors will understand we need a little bit more innovation, a little bit less traditional. That's not where we are now. In fact, we've just been through the opposite as many investors run back to their benchmarks. But we're benchmark agnostic. ARK Europe is benchmark agnostic.
We took a look at your portfolio. We found that only 4% of your portfolio is invested in companies that are smaller than $2 billion when it comes to market capitalization. Why is that so? Does innovation need big companies?
No, in fact, you'll see we have all cap portfolios. It all depends. Now, if you look at what's going on in the multi-omics world, the real action is happening in the smaller companies. CRISPR gene editing technologies have really come out of the small end of the market. And I think in terms of the way you calculated our exposure, $2 billion today is considered quite small cap. And many of the companies in the multi-omics space, the life sciences space, fit into that category because they have the patents. They're partnering with the big pharma companies. And our hope is that they will remain standalone companies and that they will scale and that no one takes them out. That's the bigger risk in that category. In the case of our average versus median market cap, the median market cap is in the $6 to $8 billion range, which is quite small compared to the broad-based benchmarks out there. Our average may skew higher because Tesla is our largest position, and that is a $400 to $500 billion company, very heavily weighted in our portfolio, close to 10%. But the median gets at what the essence of the portfolio, which is more in the mid-cap space.
So far, active ETFs are not that common in Europe. So to say, for example, we have about 2,500 ETFs in our German database, and about 100 of them are active. So it can be considered quite a niche in Europe. Why are you so interested in coming here? And what makes you confident that ARK Invest Europe, the company it's going to be, will thrive?
Moving into Europe reminds me very much of moving into the US with active equity ETFs, fully transparent. In 2014, 2015, most people did not think they would survive. They didn't think there was an appetite for them. And we found out the demand was there. And it started with independent advisors, not associated with any particular bank or investment firm, and then moved towards what we call the wirehouses. So the Morgan Stanleys, the Wells Fargo, the Bank of America. And we've been quite successful. What has surprised us is it has taken roughly 10 years for our market to catch on. Now, the traditional players, and an example is Capital Group, it entered the market February a year ago and is doing quite well with active, transparent ETFs. So we think that these companies are validating the strategy in the US, and we think the same thing will happen in Europe. 25% of our subscriber base is from Europe. And the number one question we have gotten over the last 5 to 7 years is, why can't we access your strategies in Europe? When will you have a UCITS ETF? With the acquisition of Rize, we now believe we can enter Europe. We didn't think before, as an American company, that we would be able to enter Europe in any effective way because there are so many differences between the US market and the European market, not the least of which is many languages, which, of course, ARK Invest Europe, nicknamed ARK Europe, we do have those languages now and close relationships with the major players in the market.
But you said that you got a lot of questions from your, so to say, fan base for coming into Europe. But do you think that's because you're offering something so far quite, maybe not unique, but in a minority, like the active ETFs? Or is it more because of your investment strategy?
I think it's both. We know that our offering looks very different from anything you'll see out there. And obviously, that's by design. We know that a lot of large cap growth companies have high exposure to the Magnificent Seven or the FANGs or whatever acronym you want to use. We have very little exposure to them because we are focused on the next big ideas. AI is a great example of this. We are looking for the biggest beneficiaries of AI, while many are focused on NVIDIA, which absolutely, we owned NVIDIA since it was $5. Now it's over $400. And we still own it in our more specialized strategies. But in the flagship strategy, we're focused on who is now going to harness AI and drive their businesses in a way that many people don't anticipate. And for every dollar of hardware spent in the AI space, so think NVIDIA, there could be up to $20 spent in software. We're trying to size the opportunities. And the way we do that is by understanding the learning curves associated with each technology. There are 14 technologies that are involved in the 5 major platforms that we have centered our research on. And those 5 platforms are robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing in the life science space. New technologies are deflationary. So these learning curves mean that costs are falling over time as units scale. So we're trying to understand how quickly the costs are falling and how quickly, therefore, these new technologies will be embraced by new sectors and industries. And we're also learning about the unit economics, the competitive dynamics as we're doing that kind of research. The bottom-up research it starts as we're doing our top-down and learning which companies are making these new markets happen. We are as bottom-up stock research driven as any other team out there, but our investment time horizon is different. Many teams have a 1-year time horizon or an 18-month time horizon. We have a 5-year investment time horizon. And when we're talking about exponential growth technologies or super exponential growth technologies, as these technologies feed each other and converge, that the difference between linear growth and super exponential growth in the very early years, very little. But if you give us 5 years, that difference is huge. And most analysts and portfolio managers, investors, are not thinking enough, we do not believe, about the super exponential growth trajectories out there. And then the final part of our process is a scoring overlay. So 6 metrics, very important to innovation. Do we have a visionary management team? Is this management team headed in the right direction strategically? And are they so focused on that long-term opportunity that they're willing to invest aggressively now and forego short-term profits in order to capitalize on these huge opportunities? Of course, our governance ratings would be involved in that score. Then we have moats or barriers to entry. I think that one is pretty self-explanatory in the form of patents, or you may call them patents in Europe. I'm not sure. And also speed at which these companies are operating. That often is a competitive advantage. And then product and service leadership. That's a quantitative metric. Market shares, keeping focus on market shares. Then execution. Execution to us does not mean necessarily meeting the streets or the market's expectations. It is understanding where these companies are spending their R&D dollars. Do we think they're in the right places? And how much they are spending. Are they spending as a percent of revenue enough? As well as understanding whether the visionary leaders from a technology point of view have surrounded themselves with the right business leaders, with the right sales and marketing teams. And if the management is evolving from startup into scaling territory, are they bringing the right new team members into? And then valuation. We're looking at valuation 5 years out. And what we're doing is assuming that whatever the valuation is today, which tends to be high because these companies are investing and foregoing short-term profits, we're assuming that enterprise value to EBITDA multiple is coming down close to a market multiple over the next 5 years. That's a big headwind that we have to overcome through an expectation for revenue growth and margin expansion during the next 5 years. And then the final metric is thesis risk. Thesis risk is government regulation going to throw off this technology, or is taxation of some sort going to throw off this technology, or are subsidies going to help it? We never incorporate an expectation that subsidies will last, but it certainly can be helpful in the short term.
I was just wondering whether there are any European tech companies that you see as promising according to those metrics?
One of our largest holdings is UiPath. Daniel, the founder, is from Romania. And while it has offices around the world, very importantly, a lot of its business and European headquarters is where a lot of the action started. And UiPath, is a robotics process automation company. And so what this company is doing is taking mundane, everyday work processes and helping make them more efficient. And the way they're doing that is they're taking all of the data that they've collected from corporations around the world who are willing to compare best practices with one another. So they're using OpenAI and Anthropic and Llama 2 to train on this data. And they're using their own expertise to create specialized models. So when I talk about the 4 characteristics that we think are going to become very important in artificial intelligence, UiPath has all of them. It has domain expertise, probably the best understanding of work processes across sectors of any company out there, and a focus on that. Microsoft may have a product here, but not a sole focus on it. Then they have AI expertise. They're taking this AI movement seriously and bringing in-house data scientists as they use these open source models, which are free out there, of course. And then they have global distribution. And finally, proprietary data that no one else has, certainly the aggregation of data on work processes around the world.
So when you talk, like right now, about specific companies that might be an interesting investment case, it's all over the news because you're so well known. Usually, fund managers are rather tight-lipped when it comes to specific investments. Your approach is different. You're rather transparent. Is that a reason that the lack of discretion influenced your investments decisions?
One of the reasons we are what many people call radically transparent is because of what happened in 08-09. And we felt that the new investors coming along were demanding transparency after that crisis happened because of the lack of transparency. So we want our investors to be on the journey with us, to understand what we're investing in, why we're investing in it, and when we're investing in it. Now, I will say the rest of the industry has not really followed us in this regard. We are seeing more fully transparent active equity ETFs. That is true. But they are not giving their research away as we are. We even publish models when we think that a company is wildly misunderstood or inefficiently priced. And what we do when we model a company is we leave variables open so that if anyone wants to change those variables, so you can find Tesla's model on GitHub or on our website, and you can see what assumptions we're making. And if you disagree with them, you can go in and change them and see how that changes the expectations for our bear, base, and bull cases. Now, when we think about the publicity we're getting, during a bull market, it's extremely positive and we can do no wrong. In the bear market in 21 and 22, the publicity became very negative, but we didn't change anything we were doing. We will remain transparent. This year, it's been mixed. We had a good first half of the year. The second half is tough, as it is for all growth investors. We see many portfolio managers and analysts, what we call hugging their benchmarks. And that means they're buying benchmark stocks, and they'll often be selling our stocks when they do that, because most of our stocks are not in benchmarks. And we like that. We like offering a differentiated exposure to truly disruptive innovation. But it does make it difficult when there is a risk-off period. It makes it difficult for people to understand why we are buying more aggressively our stocks that are not in benchmarks. That's where the real opportunity is, we think, to distinguish ourselves when the bull market resumes.
To make it a bit more specific, the ARK Innovation Fund lost 67% last year. And as you may know, we at justETF focus on retail investors. And for them, that might be a lot to bear. This kind of volatility. So who's the target group of your ETFs? Is it more the institutional investors?
Well, our audience in the U.S. is more retail. Now, there's retail and there's retail. There are individual investors, do-it-yourself investors. They have been interested in our strategies because when they look at our strategy relative to other growth strategies or even innovation strategies, they see a group of stocks that they have no exposure to. Many of them are involved in crypto or digital assets, which are extremely volatile as well. And so they understand that innovation in the early days experiences great volatility, and many of them will trade around that volatility, or they will average down and become more involved as a strategy, whether it's crypto, digital assets, ARK's disruptive innovation. They will average down into the strategy. We also have retail in the form of gatekeepers. So gatekeepers, like the big banks, they will put us in a high volatility category, and they will suggest that if you want to become involved with the ARK funds, don't make it all of your equity strategy. They never would. Make it a small slice, maybe 3, 4, 5% of your equity exposure. And just understand that it is volatile and you may want to trade around it, trade around that volatility as you're getting your average position in place. We do have institutional clients. Our first big one was joined us in March of 2016, so 7 years old, and has stuck with us the entire way. That institutional investor said, you look like the closest to a venture capital fund in the public equity markets, but our costs associated with you are much lower than a venture fund. And we are a long-term holder.
You just mentioned that retail investors might only invest a small percentage in an ARK Invest fund. But maybe you can tell us in general, which portfolio allocation would you suggest to a retail investor?
It really depends on the risk profile. If a person is young, just starting in his or her career, and wants to start saving for retirement, as my children are doing, what they're doing is they're putting $25 into ARK funds, maybe either once a week or once a month, and maybe into crypto or digital assets. And both of those seem like very high risk. And that may be true, but they're also very high return. And they can afford to think very long term. And so they should be thinking about ARK and digital assets the same way they would think about venture capital. You know, venture capital investors do not look at their portfolios every day.
If I may jump in here, what I meant was like, what kind of other assets, like what kind of asset distribution, asset allocation would you suggest?
Many people say 60% equities, 40% bonds. That's just 60-40 is the shorthand answer to that. I think it really depends on a person's risk profile, as I just mentioned, and I think it also depends on what is going to happen to the economy. So right now, bonds have had the worst sell-off in the last 2 to 3 years, really in history. Now, most people for the last 40 years thought bonds were safe. The last 3 years, they have not been safe. If we are right, then bonds are going to be a good place to invest again. Why? The reason they've sold off is very tough monetary policies as inflation, which we think was more of a supply chain crisis issue than a monetary issue. We think that inflation is going to continue down. Many people feel it might be stuck here. In the US, we've gone from 9% CPI down to, I think it's a little over 3.5%. We think that number is going to continue down, and we think we could see deflation before this is over. If that is right, then bonds are going to be a good place for a young person, let's say a retail investor. I would probably go. Now, this would be for have a lot of risk appetite. They're not going to look at their portfolios every day. I would probably go 50% equities, 20% digital assets, and 30% bonds and other fixed income bonds of all maturities. That would be for a younger person. For an older person, you'd lean more into bonds if we're right. And so you might do the flip side of what I just said, and they may not want to own any digital assets, but we do think digital assets are going to be a very exciting and rewarding place to invest.
The interest rates have risen lately massively in the US, even more than in Germany, for example. What impact do you expect on your strategy in the midterm from this interest rate?
In 2021, when the market moved to all-time highs, we got hit because of fears of higher interest rates. Then in 2022, we got hit even harder, as you mentioned before, because of the reality of rising interest rates. And then this year, we started off very well. We're holding our own, but since the beginning of August, the higher for longer has hit our portfolios. So we think we've been hit by what has happened and what is likely to happen. And if we're right on our outlook that inflation is going to continue down and surprise on the low side of expectations, and that the economy is going to be softer than the Fed expects in the weeks, months, and quarters ahead, we think interest rates that first we will have the expectation that interest rates will come down. That will help us. And then we'll have the reality of interest rates coming down, and that should help us. There's so much cash built up on the sidelines now that we think that cash, at the first sign that inflation is a big surprise on the downside or the economy is much weaker than the Fed thinks, when that happens, we think cash will start coming back and rewarding our strategy.
Thank you so much for being with us today.
Thank you, Suzanne, for giving us the opportunity, both ARK overall, but especially ARK Europe, to be introduced more formally to Germany and the rest of Europe. And I'll look forward to taking this journey with you again in the future.
Und dir vielen Dank fürs Zuschauen. Lass uns gern ein Like und ein Abo da und ansonsten wünsche ich dir viel Erfolg beim Anlegen und bis zum nächsten Mal.